Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 4:30 in New York on Wednesday, May 11th, 2016, and we are looking at the Dow Jones Industrial Average after being up in triple digits yesterday, down in triple digits today, trading off about 217 points at 17,711. S&P also trading lower on the day. So traders, here we are again. One day with a phenomenal upside rise to be followed by the subsequent day with a superlative negative ride, a ride to the downside, down 217 points on the Dow Jones Industrial Average. Let's take a look, though, at the Standard & Poor's. And when we do that, 2059.50, putting it off about 18 points on the day, the low being 2057.50, the high being 2078. And again, we have this market trading down in double digits. Now, it did not give back as much as it gained yesterday. That's the first positive note. Second positive note is that when we look at this 50-day moving average, and for me to believe that this market is going to move into a subsequent sell-off greater than the congestion and sideways trading action that we've witnessed, we would obviously need to see this market break below this 50-day moving average, and then we would look to see if it found some support at about 2006. But as long as it is above this particular moving average, the short-term 50-day, then it tells me that we are still looking at a market that is trading in a tight, narrow range as it attempts to flirt with these record highs, but each time it has challenged those highs, the last time being here in April, it was unable to sustain any kind of long-term move in which the market closed above that. And so what we've seen is we've seen the market caught between an area of about 2,000 in the S&P on the low side and 2,100 on the high side, but absolutely a congested market. And one of the things that we pointed out on a show, I believe it was last week, was that what you get with these congested markets is really alternating candle color, because when the market sells off, you will get an abundance, of course, of red candles, simply stating you're getting lower closing days. The opposite is true for a market moving up. You should have an abundance of consecutive days in which the market moves up. Sideways, you're getting alternating candle color. Red, green, red, green, red, green, red. This could be either, but doji, red, green. You get three here. We talked about the fact that that was the maximum we've seen really is four right here and three right here. And so we've really not had any kind of dynamic move in the market that has lasted over time that really would indicate the strength needed to break above these highs. But the other way to look at it is that what we're looking at is the market simply forming a base. It is consolidating. It is trading in a defined range, and we could see it break to the upside as well as the downside. In other words, all hope is not given up in terms of a major rally throughout this year, but the recent action has indicated that if it happens, it's happening against some pretty strong headwinds. Surprisingly enough, we do have a substantially higher day in crude oil. We had that with a substantially lower day in equities. Equities on this particular chart is on the bottom. This is the E-mini S&P that we just looked at. Today's activity here, and then take a look at oil. So you're absolutely getting somewhat of a decoupling, and oil has broken above 46. Now, this chart hasn't updated, but it did close at 46.08, up over 3% on the day, and that's almost $1.50 rise per barrel. This has been Gary Wagner, wishing you as always good trading. Obviously, maintain your current long position in gold as well as your stop. We will be looking at the S&P, but I do want to see it either hold the 50-day moving average or break below it before making a decision. Bye-bye.